We're touching on the cost to income ratio because that has been steadily declining over the period. It was at 51.2% not too long ago, dropping down to 50, and now it's around 47%. Big focus on cost containment, but also revenue increasing dramatically over the period.
Yeah, we've benefited. Obviously, the cost-to-income ratio benefits from an increase in revenue, and revenue growth has been quite strong at just over 20%, 21%. The assets have actually grown by 21%. Yeah. The revenue has grown by a bit more than that, in the sort of mid 30%. But I think that the focus on costs, we benefit by having quite a large variable cost component. So it flexes. A large part of our costs, almost 2/3 of our costs, flex with revenue and asset size, both to the up and to the down. And then the fixed cost component is relatively small, at just under 250 million. And so we just focus on that because that's what we can control, and it's worked well for us.
I mean, we also have fees with regards to performance, and you've actually been doing very well despite all the volatility that we've seen.
Yes.
How does fees obviously play a role with regards to the overall performance of Coronation? I'm sure it is also very important, as it is important that assets under management increase.
Yeah, so fees are our equivalent of price for a normal business that sells product, last year, that net revenue margin was 70 basis points. This year, it's 69 basis points. So, year on year, it's been fairly similar. And over the very long run, the long run average is very close to 70 basis points as well. So, where we sit at the moment from a fee perspective is more or less on our long run average fee.
With regards to market share, you've increased your market share to 9.9%, and this time last year it was at 7.5%. Tell us about the strategy going forward. Now you're the second largest asset manager in the country. Can you maintain this? Is it really performance-based, or would you say that it's a combination of strategies that you've deployed?
Yeah, so that market share refers to our retail market share, where we've gone from a 40 billion rand management company to a 62 billion rand management company. And we've taken 20 billion rand of flows in during that year, during the course of the last financial year. Our business is founded on performance, so investment performance and returns to clients. So it's really the cornerstone of the business performance is based on the investment performance that we achieve for clients. So without that, regardless of what else we might do, it wouldn't really be that relevant. So a large part of the growth in market share is really ascribable to the long run, sort of 5-10 since inception year performance that we've delivered across the fund range.
And of course, performance is very key for pension funds as well. Give us an indication of pension fund flows relative to the retail market.
So total flows, our assets under management have grown by 43.5 billion rand this past year, and 30 billion is ascribable to net flows. And I've already said that 20 billion related to retail, so the 10 billion relates to institutional flows. And that's also been across the board, across a range of mandates, a lot of global mandates and foreign mandates. We've been fortunate enough to be awarded. And so, all parts of the business have really done very well this year.
Are you expecting more flows from the pension fund industry down the line? Do you want to attract those flows going forward?
Yeah, we do. We have notified our client base that come end March 2012, we will not be participating in new mandates, pitches around specialist equity mandates on the institutional side. It doesn't affect our retail business, doesn't affect the multi-asset class business. And that's really because we want to protect our ability to generate the returns that we are looking to generate for clients. If we allow the business to become too big in certain segments, then we start to undermine that ability. So it's really just trying to be prudent around being able to fulfill on the promises that we're making. And so one should see, that'll be effective, as I say, as at the end of March 2012.
Does that change your risk profile? Does that mean you can take more risk on?
No, not necessarily. Not necessarily. It's just that asset managers are capacity businesses, and essentially, if we become too large within a particular market, which in this case we're talking about Johannesburg Stock Exchange equity, then we limit our flexibility and ability to generate these returns, which we don't want to do. So hence the decision.
Very quickly going forward, are you confident of maintaining these double-digit growth numbers?
Asset management businesses are quite exposed to capital markets. So it will really boil down to what actually happens in capital markets will play a big role in terms of what we deliver. And also our size will start to become an issue. So one will have to see.